let's just jump into year-to-date performance and results in the marketplace. Um, the S&P 500 is up 21% year-to-date, and despite all that the market has wrestled with and the headwinds that it's overcome, including supply chain disruptions. If anyone has read the letter, it's an inside joke that even supply chain disruptions have been an obstacle this year, and that's what everybody's talking about. But despite all of that, the S&P is up 21% year to date, which is just really terrific. It's outpaced the Dow Industrials, the 30 largest stocks, and NASDAQ as well. Technology, big industrials have done better than technology this year. The European stock index has performed nearly as well. And for a while, as you'll recall, early in the year, the European stocks were doing better than domestic stocks. And we'll reflect on that in a moment. The Shanghai Composite Index is the outlier in terms of the broad market returns that we've seen year to date. I think the news really has been this real estate development company, Chinese real estate development company, Evergrande or Evergrande. But really, I think what's driving the underperformance in the Chinese market is a couple of things that hasn't had the same level of press. One is the new regulations that the Chinese government is imposing primarily on technology companies for transparency and access to client data. I think Chinese big technology companies were leading and determining that, look, if we're a publicly traded global company, we're not going to be subject to these things. And that's crept in and affected prices. The other thing is that there's just a global slowdown. And in China, they just posted a global growth of 4.9%, which is well down from just a few years ago of double-digit annual GDP growth. And China is one of the last COVID zero countries that's committed to zero COVID. Most other developed countries have said, okay, it's with us. We're going to figure out how to be productive with it and live with it. China is still sort of in a lockdown mode in an attempt to just completely rid itself of COVID. So underperformance there. Across the world, you can see that last index, the MSCI ACWI is what it's called. It is the all country world index. So if you look at all stocks across the entire world, they're up about 15%, again, underperforming domestic equities. So one of the things that Chris had brought up in his letter was that international stocks are trading at more attractive valuations than US stocks, and that is true. And this is a graph that just shows that the S&P 500 has had greater price appreciation for most of the year. It's interesting, if you can see my mouse, just end of May, beginning of June, there was an inflection where the market had up until that point thought that the trade would be that international equities would do better coming out of COVID, that they were lagging behind the US in a COVID response. And I think in the summer, when the world figured we're not done with COVID, money came back into domestic equities. They've outperformed, but there is a relative value in terms of international equities, and Chris had mentioned that in his letter. If we just look at sectors, I think it's really interesting. The leading sector year to date is energy, up over 50%. And if you'll recall, energy was one of the sectors, if not the sector, that performed the worst last year. It's this year's best performing sector. Financials have done well. There's just a lot of money in the banking system today. Interest rates are a little bit higher, and financials have done well. The best performers last year, information technology and healthcare, kind of are middle of the pack. And I think that this is just a good reminder of the importance of a broadly diversified portfolio with exposure in all sectors, which is what the foundation delivers to clients. It's really hard to pick the winning sectors year after year. So just to cover all your bets is a really smart and prudent approach. The 10-year Treasury yield has inched up over the summer months, primarily because of a recognition that the Fed's buying program will taper off and end sometime next year. So there's just one really big buyer that's going to be leaving the market. Supply and demand says is that prices need to go up or prices need to go down in order to find buyers. It's also a reflection of, I think, a realization that there's some increase of inflation that's going to stay with us for a while. Another one of the dominant narratives, in addition to supply chain disruptions, is this notion of a transitory inflation pressures. And I think that conversation is becoming much less about, is it transitory, and much more a question of how much of this inflation is going to stay with us for the long term. So we've seen interest rates inch up, not dramatically. The Fed has continued to commit to very low short-term rates, but it is something that we're seeing in the market. One of the things that Chris had brought up in his investor letter is this quote: "Price is what you pay, value is what you get." Most people attribute this to Warren Buffett. Chris correctly identified it as a Ben Graham quote. It became really well known because it was cited by Warren Buffett in his 2008 Berkshire Hathaway letter to shareholders. But it really isn't. It's a truth. Price is what you pay, value is what you get. So I thought that, based on that we could try to, think about equity valuations and relative performance. And I thought I'd really just go back to the basics here for a moment. And the price PE ratio is simply the share price divided by the earnings per share. Higher PE ratio is considered more of a growth-oriented stock, and a lower PE ratio is more associated with a value-related stock. And a value stock is a stock where earnings are not growing very quickly or necessarily quickly, but they're consistent and they're predictable. And there's a value in that, and typically they demand a lower multiple. So $1 will buy more earnings. A growth stock has a much higher PE ratio, typically, where the earnings growth is expected to accelerate and to remain high. So an investor would be willing to pay higher dollars today with the opportunity for those earnings to grow into and return performance. If you look at on the right-hand side of this slide, you have year-to-date performance for domestic U.S. Domestic equities. And if you look at large, mid-cap, and small cap, which is the LM&S, across value and growth, you'll see that particularly in the mid-cap and small cap sectors, that value has significantly outperformed growth. And this year is one of the first years that we've seen that relationship in a number of years. So it's notable, it's a reversal, and it is a reflection of a more conservative approach to allocating and taking on risk in the market. Chris had also talked about the price earnings ratio and historical perspectives. I didn't go back nearly as far, but he quotes in his letter that the average PE ratio over the more modern history is about 16. Today it's trading at 23. It's down from a higher level of 27 or so, So there has been some reduction in the PE ratio or the multiples. He also talks about other ways of valuing equities. You know, in particular, he talks about a dividend payout ratio, and historically, the dividend payout ratio makes equities look at fair value, maybe even attractive. There's other ways as well: price to book, price to sales, discounted cash flow method, but price to earnings really has been the predominant way to think about measuring the cost of buying future corporate earnings in terms of a share price. Part of the reason that we've seen such a strong market is that earnings have been very strong this year. In fact, last quarter, in the second quarter of 2021, the S&P earnings grew over 90% from the prior year's quarter, and 86% of companies beat their Wall Street earnings expectations. So a 90% year-over-year growth in earnings is basically unprecedented, and really has been the catalyst for a very strong market. As we saw, the S&P 500 is up 21% year to date. For the year, 2021 earnings are on track to grow 45% over 2020, the strongest growth rate in over a decade. Third quarter earnings are beginning to be announced now. We've seen big financial companies this week. We're seeing large technology companies, and earnings are coming in very strong and supporting the valuations. So, you know, that really is what is driving the market in the end, is earnings and growth of earnings. And we've seen this represents the S&P 500 over the last 6 months. We have seen, you know, just positive returns. We've seen volatility for sure, but over a long period of time, we've seen upward trends in valuation prices. So one of the things that Chris does, and I'd like to be sure to note, is he invites everyone, each of the churches, to reevaluate your investment allocations for the end of the year. And I'd like to just reflect on that for a moment. You know, I have a perspective where I see individuals and I see retail business and the way that individuals will create portfolios relative to institutions, churches like yours. And you know, my very strong sense is that individuals will overestimate their ability to weather volatility. You know, taking risk and earning money is great until there's a market correction, and very often individual investors will get out of the market and get hurt. And what I've observed is that institutions like churches are more often err on the other side and not being risky or take enough risk in a portfolio, but remain too conservative. And I just would underscore and kind of point out that, you know, the importance of really reevaluating the purpose of the money that you're stewards for, and asking, what is this money for and what is the time horizon? If the money has a longer term time horizon, 5 to 7 years or more, you know, it's very appropriate to take risk and to take on volatility and be willing to have volatility in asset prices with a sense of confidence that over a longer period of time, 5 to 7 years, that markets are going to be upward trending. And that if there is volatility, you've got a long horizon to weather those storms. Equally, you know, in parallel, if money is set aside for some near-term purpose, to fund programs or to put a new roof on the church in the spring, then a conservative allocation is appropriate in that case. If the money's going to be used in the next 1 to 2 or maybe even 3 years, a more conservative allocation is appropriate. And in that way, if the stock market has volatility and declines in value, well, you've pre-positioned your assets to stay out of the way and not be subject to that. So we talk about this. It's really the primary determinant of investment returns is getting the asset allocation correct. And the foundation has three primary models, as you know: conservative model, moderate, and aggressive. And then the ability to mix and match these to really tune in a portfolio that really matches a church's or an institution's need and their time horizons. So I just would encourage everybody to take Chris up on his invitation to reevaluate allocations at the year end here.